Federal Housing Administration, who's in charge of FHA loans, just greenlit the 40-year mortgage. Starting in May, you will be able to apply for one. But what does this mean? I find it so fascinating so far hearing the takes. On one side, we have all these realtors and lenders who, let's face it, need people to continue to buy and sell houses for them to stay afloat. Guys, good news. Guess what? Homeownership just became more affordable. Congratulations. Give me a call so we can go look at some houses. And we have the other side of the folk, people who are in the finance space who are just like, oh my God, the world's gonna end. Ah! Let's take a step back here because I want you guys to form your own opinions. I don't want you guys just to inherit an opinion and just say, okay, this is what I believe and I'm gonna die on this hill. Let's take a step back and let's understand first and foremost how a mortgage works. And what does a 40-year mortgage mean? Shoot, let's even talk about what a 30-year mortgage means. First, let's talk about how a mortgage works. So in this example, let's use a $500,000 house, which we are buying with a 3% down loan, which makes our starting loan balance at $485. To make things very simple, we're gonna use a 6% interest rate, and we're gonna start with a 30-year mortgage. So from this point on, how do we calculate the interest and the principal? Well, to calculate the interest, we only need a few numbers. The numbers that we need are gonna be the interest rate, the remaining balance due on the loan, and the number 12. So we get the loan balance, which is $485. We multiply it by the interest, which is 6%. We divide that by 12 and we get $2,425. So the interest payment is going to be $2,425. Now the principal is a little more complicated. Here's the formula. Listen, I'm not a math guy, so we're not gonna go break this down, okay? I have too many bad memories of calculus class that I do not need bringing up. Does anyone else have nightmares about them having to go back to high school? Even I'm 30 years old and I'm having nightmares about going back to high school because I forgot like to do 2-3 credits or something like that. So in this case, I'm just gonna tell you the principal payment for this specific example is $482.82. And basically the interest and the principal add up to this number. And the thing to know is that your monthly payment will always be this number. We're just talking about principal and interest. We're not talking about anything else. As long as you're in a fixed interest rate, this is a number you'll pay. But now what happens the following month is the same thing happens. But the only thing that did change is your balance actually dropped. It's no longer $485,000. It is now $485,000 minus that $400 or whatever the principal the last month took. So the interest is just gonna only very slightly modify. And basically, if that end number, the monthly payment is still the same, then we're getting that end number, we subtract the interest payment, and we see that our principal just went up slightly. So that's why in a 30-year mortgage, the majority of your interest is paid upfront. So if we use the same exact purchase price, same exact interest rate, and we're only changing the month term, the monthly payment for the 30-year mortgage for just the principal and interest look like this. Well, for the 40-year mortgage, it looks like this. So that may be a lot more quote unquote attractive, but just like everybody's gonna be talking about this, and this is just get this out of the way. This isn't gonna be revolutionary. Of course, you're paying a lot more interest. Like if you're coming to this table and all you're bringing to the table is you're gonna pay a little more interest. Okay, thank you, appreciate it. There's a round of applause. But let's talk about really what's happening here. So the thing to note is your first payment, we still are calculating the interest the same exact way. So funny enough, if we look at the first payment math for the interest, and we look at this interest the first payment, they're exactly the same. You're gonna be paying the same exact amount of money for the interest on your first payment. But because it's more spread out, there's less principal being taken out of every payment. Instead of the $400 and change or whatever it was, your first payment towards the principal is this. And that's why we equal this number. So 240, 250 bucks around there, if I recall correctly. I should probably use a script for videos, but it's been years and you would think I would learn my lesson, but here I am, willy-nilly, So the following month, we're calculating the interest the same exact way, but because the balance is not as deeply affected, like $200 less than the 30-year example, the interest is still staying slightly higher. And because that's being stretched out by 10 years, of course, you're gonna feel the difference in the pain. Yes, you're gonna pay more interest with a 40-year mortgage. Here are some things to be cautious of. Realtors and lenders are gonna love this because they're gonna feel less guilty. Hey, you can buy a house with a less monthly payment. They're there to collect their initial 2 to 3% of commission and walk, right? So they're gonna say this is great, 100%. Try to take their opinion lightly. One thing you might also hear is, oh, you just refinance down the road when rates get better. Try not to just get a house so you can refinance later. It's really dangerous to say, oh, well, I'm gonna stick with this high month payment only because down the road things will get better and we'll refinance. And I'm going to get this 40-year, but only because down the road when things are better, I'll refinance. The grass is always greener on the other side. Not only just specifically talking about the market, but you think like there'll be another version of you down the road that can afford more or that can maybe have more money or whatever. It's a dangerous thought, and I play things very conservatively. I'm not going to tell you, oh yeah, things are great. I had a guy email me the other day telling me that I'm giving poor advice because I'm telling people to buy based off their current income and not future income. Okay, that's how I roll. I'm going to always go based off the worst case scenario. And worst case scenario is you never get a raise in your life. You get to stuck with this payment for the rest of your life. That's what you should go and you should afford. It's another loan product. It's not going to be the end of the world. You have another option at your disposal. Long term, not the smartest move, but this is your decision. If you feel like, well, I'm only going to, I have this 5-year, I'm only going to be here for 5 years. Then after these 5 years term, I'm going to actually move into this city because I'm going to get a promotion or whatever. And you want to take that gamble at that 40-year, this is your life. Don't let people on the internet make you feel stupid. They agree, all right, good job, Joe, with the American flag as a comment section. You bought a house 10 years ago and you got an amazing rate, and now you're here typing on the keyboard making people feel like shit because we have to live somewhere. What do you want us millennials to do? Just be on our ass and play freaking Resident Evil 4, which I haven't been able to play because suddenly my wife and I, she's 7-8 months pregnant, and we want to be playing Minecraft every night, so now I can't even finish the castle section of Resident Evil 4, one of my favorite games that just got remastered. People are going to have their opinions and they're going to make you feel like shit, whatever. Obviously, if you're going to be here the long term, try not to go 40-year. It's going to cost you a lot more down the road. But if this is a short-term house and you're going to for sure be moving up because of job or location, or you're just kind of testing out the waters and moving to a city to see if you like it, I don't blame you for going 40-year and just kind of testing the waters. And hey, turns out you actually love the area, but you didn't necessarily love the community. You're gonna pay the bank a lot more interest, yes, but hey, you have less monthly payment to pay, so maybe you can rent out and make a little more money. Whatever. At the end of the day, this is your life, your journey. Make your best decision for yourself based on your current budget. Don't let people's opinion on the internet make you feel dumb. You understand how mortgages work now. Make your own informed decision, have all the options presented to you on paper by the lender, and make the best decision that you want to.